that's the broad summary, the big picture on market. How do we look at it? That's the executive summary. Global environment is weak. Global money, most of the other countries than India, like US, like Europe, Japan, China, these are big economies. All of them are seeing some weakness in their overall economic outlook. They had seen a very strong turnaround post-COVID, and now after that turnaround, it brought in big inflation numbers, because of which their central banks increased interest rates, and now because of that increase in interest rates, the economies are started to slow down. So I think one simple principle which you have to realize is that when economy grows fast, it increases inflation, and when inflation goes up, the central bank gets worried. It puts in the brakes in the form of interest rates. So interest rates go up, and there are brakes applied on the economy, because of which the economy starts to slow down once again. And at a point of time when the economic growth falls so much that once again the central bank puts on the pedal on the accelerator. So they once again press the accelerator in the form of reducing the interest rates. So this is the current trend, is the global central banks are applying brakes. That's what is happening for global economic. India is looked upon as an oasis of positives. Indian economic growth is very well balanced. It is very strong. It is expected to be almost 2 times the global average for the next 2 years. We have estimates only for the next 2 years. Otherwise, if we stretch for 3, 4, 5 more years, still our growth will be much stronger. So India's growth is strong. Inflation expectations have substantially improved, meaning reduced for India. India will be the first country which will see a decline in interest rates going forward. So our central bank actually is now ahead of the curve. Before the American central bank, we increased our interest rates. Before the American central bank, we actually stopped increasing interest rates, and now we are expected to be the first of the block in reducing interest rates also, which will bring in lots of credibility to our central bank, which is the Reserve Bank of India. One more aspect which we will discuss during this presentation is that long-term stock price returns are driven by earnings. Everyone knows this, everyone talks about this, but as we see in the markets today, and we will discuss that using some of the numbers, that is not showing up, meaning short-term markets can fluctuate and can completely be out of whack with the underlying earnings. But long-term, it's always driven by earnings. Small and mid caps have significantly outperformed large caps. All of you know that, right? There's one important point, once again, which we will discuss in depth. And this is a trend since 2020, and something which has accelerated, which means this trend has worsened since 1st April 2023. And what is this trend? The trend of low quality and low growth companies delivering much better returns than high growth and good quality companies. Longer term, 10 years, 15 years, 20 years, we have always seen the reverse happening. Very intuitive, right? Because good quality and high growth companies should ideally do better than the weaker names. It has always happened, but in the last 3 years, the reverse has happened, especially in the last 1 year. The possible reason is a little bit technical. We will also discuss that while we will be discussing the slides. And finally, the valuations broadly are reasonably good for large caps. Large caps are fairly valued, whereas small and mid caps are on the expensive side. This is the table which is being given by the IMF on projected economic growth. As you can see, India's growth rate is expected to be about 6.5%. Remember, India is also going to see some slowdown. From about 7%, we are going to see some slowdown to 6.5%. and everyone else is also going to see some slowdown. But our growth on an absolute basis is going to be much higher than almost everyone in the world. On a global average basis, India is expected to grow 2 times better than global average. This slide broadly talks about how interest rates have gone up, and due to increase in interest rates, we have seen a decline in inflation. So in the first phase, in various countries, we saw interest rates go up and inflation starting to cool off, and in the next phase we will see interest rates starting to cool off and inflation stabilizing. I won't spend that much time in these aspects because I am sure you are now very well educated on interest rates and inflation. So not much time spent there. India's latest quarter's earnings, once again fairly well understood. We are growing well. Corporate earnings have been strong, but this quarter the earnings have been largely driven by margins and less by revenue growth. But still, overall earnings growth has been strong. So now we will discuss something which is a little unique, a little different. So all of us have heard about, small caps, mid caps, large caps, and relative valuations of all of that, right? The press, newspaper also keeps talking about small caps being expensive. Froth is there in the small and mid caps, so stay away, right? There is a lot of speculation in these spaces, so you should take less risk. You should go in the large caps and stay there. What we are saying is, this is not the correct approach to look at it, because there are multiple ways in which you can segment the market. One of the ways which all of us keep doing is by market capitalization. The companies who have bigger market capitalization are called large caps, smaller ones mid caps and small caps. What we are saying is, the better approach to analyze the trends in the market is to look at what is happening to companies which have got different types of quality and growth. So we have created 3 simple buckets. We looked at all the 500 companies, NSE 500 companies, the top 500 companies, and divided it into 3 buckets. First bucket is high growth and good quality companies. So first one, we will call, in simple words, we will call them as good companies. Second is companies which have got either good growth or high quality, either of these two, high growth or good quality, either of these two. Third is companies which have got neither good growth, which means they are low growth and low quality. So 3 baskets. Am I clear? So when we analyze the market using this 3 basket approach and look at the average returns in all of these 3 baskets, we get a very different trend. And what is this trend? It is a very clear red flag. The red flag is especially in the low quality and low growth segment of the market. Look at the third line. Neither quality nor growth. And the table in the bottom, that tells you the alpha, which means how much each of the basket has delivered returns versus the overall average. So for example, in fiscal year to date, low growth and low quality companies on an average have outperformed the overall returns, or the overall universe, by 18%. Whereas high quality and high growth companies have actually underperformed the overall universe by 11%. So the gap between good and bad is actually 29% in this 1 year. So now, if you look at over a longer period, start looking at it, what has happened over a 1 year, 3 year, 5 year, 10 year period. Even on a 3 year basis, the low quality companies have done better. As you can see, over a 3 year period, low quality companies have actually delivered 8% higher compounded returns versus 3% negative returns for the high quality basket. So once again 11% gap on a 3-year basis compounded, which is roughly 35%, all of which largely has come from this year. So as you can see, this year for a 1-year basis there is almost a 33% gap. Excuse me. However, the same companies, the same set of companies over a 5-year and 10-year basis have delivered very different returns. Over a 5-year and 10-year basis, the good quality and high growth companies have actually delivered much higher returns compared to the low quality and low growth companies. So the big conclusion which we derive from this is the froth is not in small caps, mid caps or in large caps, but it is in low quality and low growth companies. I'll also show you one more study of the Indian market over a 20-year period using the same baskets in a few slides later. But this is the first big conclusion. Second, when you look at the benchmarks, so when you are selling a fund, you always, your customer will ask, how much better this fund has done better relative to the benchmark. You will see, this year sir, my fund is not done better relative to benchmark. You pick up any mid and small cap fund this year, you will 90% of the time you will see that the fund has underperformed the benchmark. Maybe only 1 or 2 funds out of 30 funds would have outperformed the benchmark, especially the mid cap and small cap benchmark. Why? Because if you look at the composition of mid cap and small cap benchmark, 30 to 35% of the benchmark comes from low quality and low growth companies. However, if you go towards the large cap benchmark, you will see that the proportion of lower quality and low growth companies is much smaller, and hence most mutual funds would not want to include such companies in their portfolios. So the recipe for returns in this year was how much can you add weaker quality companies and low growth companies to your portfolio. The higher the exposure, higher is the return, and the lower the exposure, lower is the return. To add fuel to the fire, what has happened? In the last 2-3 years, investors have suddenly become very excited about the rise in prices. So all of us investors want to extrapolate. Last 1 साल में 15% रिटर्न आया, तो नेक्स्ट 5 साल में तो मेरा 75% आ जाएगा, 100%, 25 years में तो इतना हो जाएगा. So we like to build dreams, right? In a bull market, most dreams appear to be getting true, right? It seems everything is possible. So everyone starts building dreams, and that is the worst thing. Never extrapolate. Don't think so what you have seen in the past is going to be repeated in the future. Don't build dreams based on past returns. It is dangerous. Investors have done that in the last 3 years, 2 years specifically. Most of the investors have put money in small caps or mid caps, mainly small caps. Because why? Zyada return. That is, and when that happens, they give money to the mutual funds. Mutual funds put the same money in the same small number of small cap funds, small cap stocks. So it is like virtuous cycle. Investors keep pouring in money. The same money keeps chasing the same number of stocks, limited float stocks, which means the share prices will keep going up. NAV goes up, investor is also happy. He keeps giving him more money, everyone is happy. Till the point someone breaks the chain. And that moment is very, very scary. So, just to highlight, this is what has fueled what we have seen in the last 1 year in terms of small and mid cap rally, especially in the weaker names. Now, We do some more proprietary work at PGIM to understand what is the fair value of various segments of the market, because this is very popular. I mean, wherever we go, people ask us, how do you feel about the large cap, small cap and mid cap? So we have to have an opinion, and hence we also do some work on the capitalization side. So as you will notice, there is a chart on the right side which talks about, which shows how Nifty's fair value has moved and how Nifty has moved. You will notice that there is a very strong relation. As the fair value keeps going up, market tracks it. Some years it will be slightly higher, some years it will be lower. I think the COVID period was lower, significantly lower, but then it caught up. Once again it swung back, and now it is more or less in line with the fair value. So the fluctuation in markets in large cap is limited. It revolves more or less around the fair values. But in the mid cap, there is no such limit. It can go anywhere. So as you can see here, both mid caps and small caps are trading at a significant premium to their current fair values. Now this is one more very powerful table. We have talked about how markets are slaves of earnings. Right? Long-term returns are driven by earnings. So you look at this data from the year 2018 to 2023, every segment of the market actually delivered returns in line with the underlying earnings. If the earnings growth was 11% for large caps, large cap return was 11. For small and mid cap, if the earning growth was 9, market returns was 9. Small cap 7%, the returns was 8%. So not much gap, right? What has happened this year? Everyone has broken the leash. I don't want to follow earnings. I can do whatever I like. So large caps have delivered 45% return for a 27% earnings growth. Small mid caps 57% returns for some 25%, 21% earnings growth, and small caps even better, 70% returns for a 25% earnings growth. We have borrowed 2-3 years or 4 years of returns from the future for some of these segments of the market. So clearly parts of these indices are expensive. Going forward, the large caps will deliver roughly 20% growth in earnings. The mid caps and small caps will also grow somewhere between 19 to 23% earnings growth. Not big. So what will happen is, over the next 3 years, your earnings will keep compounding at, let's say, 20%, but you have already paid for 70%, 80% in this year, which means either there has to be a time correction, which means 0% return, 20% earnings growth, 0% return, 20% earnings, and then they both meet each other, or there is a correction. Either of this has to happen to ensure that there is a balance. But, sorry, actually I will go to that slide. I think one more important thing which you should look at. Tell me, generally small caps and mid caps grow faster than large caps, or large caps grow faster? Small caps and mid caps, right? But when you look at this data, what happens? Which segment is growing fast? Large cap, right? 11% versus 9% and 7%. Why is this happening? It is because of this chart. If you look at the index composition for small cap and mid cap, as I discussed, 30 to 35% comprises of low quality and low growth earnings companies. So it is these low growth companies which in the index are actually pulling down the overall universe earnings, and hence the overall growth in these indices appears at just 7-8%. If you look at the good quality and high growth segments of this market, actually it is growing at 25-30% per annum, which is what small cap should be growing at. Now coming to caution, red flags, areas which investors should avoid. These are 7 places which investors should avoid today. We call them as micro bubbles. If I were to look at the overall market 100%, these will comprise of roughly 15 to 20% of the market. So not a big component of the market, but clearly these are places where investors should avoid taking exposure. Remember, you will underperform for some time because your competitor who has invested in some of these weaker areas of the market is going to keep doing well. But over a period of time, remember, market is a weighing machine. It is not a voting machine. In the short term, everyone is putting votes. I like this company. I like, for example, I like this IPO company. It is very hot. The grey market is hot. I look at the grey market premium and I buy it. So everyone is voting. But that's a short term phenomenon. Once the company is listed and it all settles down, markets come back to the senses, it will start weighing everything. What should it be worth? And then each and every company's share price will be driven by what it is actually worth, not by the votes it receives. So 7 places where you should ensure that your client's capital is not invested in. First and second is low quality and low growth small caps and mid caps. Third is IPO companies generally. Remember, there will always be exception. We are not saying 100% of all companies are bad. But a material portion, a majority of them will satisfy this criteria of being in bubble. So most of the newly listed IPO companies. Then fourth, very important, public sector companies. Fifth, industrial and capital goods companies. For example, companies in the railway sector, companies which are in infrastructure sector. Some of those companies are clearly in bubble zone. Sixth, companies in the real estate sector. So all the real estate companies in the stock market are trading like hotcakes. Remember, this is a very cyclical sector. This year the real estate index has delivered almost 70-80% return, I think 70% return, but the underlying fair values can't compound at that pace. So clearly that is an area which one should look to avoid at this point of time. And last one is micro caps and SME stocks. I am sure no one invests, so we can safely ignore that. But that's a segment of the market which is completely in a different territory, clearly in a bubble phase. So these are the 7 micro bubbles which are growing in the market, and we would want to ensure, you should ensure that investors are cautioned before they invest in any of these. Now comes a very interesting part of what we do at PGIM. Little different than the market outlook. What I will do is first complete our market outlook and then we can talk about this. So this is the broad final slide on our outlook, and then we will discuss something more or less interesting depending on your interest. But in this final slide we are also talking about our sectoral preferences. So overall we like the market. We think we are very positive on the market. The markets are not expensive in high quality and high growth companies of the market. These are reasonably valued and they are attractive from a 3 to 5 year point of view. So we are optimistic on the markets. In terms of segments, in terms of sectors where we are positive on, first is consumer discretionary, second is financials, third is healthcare sector. So these are sectors where we are broadly positive. In terms of underweights, sectors which we don't like, where we are having a lower than benchmark exposure, first one is materials. These are largely commodity companies, so we are underweight there. Second would be utilities, not written it, but utilities are an area which just get fixed returns and we want to remain out of many of them. Third is IT sector. IT sector, it's an attractive sector, but today it is going through a growth challenge. The growth is lower than what we think it should be. It's a cyclical low. We will keep observing this sector. As and when we think that growth is coming back, we will go and increase our exposure. So it's more of a tactical bet today. We are underweight and watching very keenly. So I think those were broadly our views on the market. I'll now quickly cycle back to something which, as I promised, gives you a different perspective. So, as students of finance, all of us learn about a lot of things. Markets work. You buy low PE companies, you will do well. Someone says you buy dividend yield companies, you will do well. Someone says you buy high growth companies, you will do well. All of this is good, but is there evidence? Meaning that if I did this consistently over a 20-year period, I would have delivered better returns than the market. Is there a study which has been done like this? Is there some concrete evidence to something which we keep talking about? Because otherwise the narrative will keep changing. Today growth is doing well, so I will talk about growth. Tomorrow cheap companies are doing well, I will talk about cheapness. There has to be some common thread which runs across time. And what is that? This is what our endeavor was when we did this study. So we looked at all the top 500 companies which existed in India at any point of time in the last 25 years. There are about 1600 such companies. Meaning, some companies came in the future by IPOs, some companies went through bankruptcy, but there were 1600 unique companies which were in NSE 500 at any point of time in the last 25 years. And those companies are part of the universe. So we did this study on this kind of a universe. And just like in the previous slide we discussed, we divided it and created 3 sets of portfolios. The good portfolio, the average and the bad. Good is good quality and high growth companies. Average is either good quality or high growth companies, and bad is low growth and low quality. Okay. So these 3 buckets. So now what an investor did is, for judging whether this is a good quality company or good growth company, he looked, let's say he started in 2005. He looked at the previous 3 years data. 2002 se leke 2005, all of that is available, right? Once we look at historical data, it should be available. So he looked at the historical data, previous 3-year data. He looked at sales growth for seeing whether it is a good high growth company, and he looked at return on equity to see whether it is a good quality company. Both these are quantitative parameters, simple, and then created these portfolios. He held on these portfolios for 3 years, from 2005 to 2008, right? Because in 1 year, 2 years you don't get any results. So we hold it for 3-year period, and then measure the return of the average portfolio, meaning there would be roughly 300-400 stocks in each portfolio. What is the average return of each stock? Remember, it is not market cap weighted, which means 1 or 2 or 3 companies will not determine the overall return. A 10 lakh crore company is the same as 100 crore company. Now, the average return is measured against the overall universe, and then we see whether or not this portfolio has outperformed. So now in this case, for example, when you look at quality and growth, maybe it's not visible to some of you, so I'll read out.
You can have a pointer actually.
Yellow
button.
This one. That's a good idea. So 11% return for companies in the good portfolio, and this return is from 2005 to 2008, right? 12% return for the average portfolio and 10% return for the bad portfolio. Overall average return is 12% for your simplicity of understanding, for your sake we have tried to put down these numbers. So the good portfolio actually underperformed from 2005 to 8 period, average outperformed, but the bad portfolio actually underperformed severely, right? This investor kept on doing this every year. He looked from 2005, he looked at the previous 3 years data. Then in the next year, 2006, he once again looked at 4, 5, 6, created a portfolio, waited for next 3 years, 7, 8, 9, right? And then this is what he generated. Just itna mehnat karke just 20 basis point alpha, nothing, right? But look at the underperformance of the bad. This is, remember, this is the post Lehman crisis crash. The bad companies actually underperformed severely. You kept on doing this right up till 2020 March, because if you create a portfolio in 2020 March, you will only get the returns up till 2023 of March. We will add one more column in the next 7-8 days, because we will get data for 31st of March 2024. So March 21 से लेके 24 तक का data भी आ जाएगा. The summary of all of this is presented here. As you can see, the good portfolio has actually outperformed by 200 basis points on an average, means 2% extra return. अगर यूनिवर्स में डालते तो 10% मिलता. If you invested in a good portfolio, it has delivered 12%. So much higher return. The bad portfolio has actually underperformed by almost 280 basis points. Number of times the good portfolio did well, 63% of the time. Significantly better. मतलब almost 2/3 of the time the good portfolio outperformed the bad. Simple answer, right? So what will you do when you look at this data? You will invest in good companies only, no? Or you will go and pick the bad companies? You will invest in good. Simple hai. But when you do these simple things, this is what happened. In the last 3 years, the good companies underperformed the bad companies, such that it has never happened in the past. 7.3% underperformance in the last 3 years, compared to 5% outperformance for bad portfolio. So 12% outperformance of bad portfolio over the good portfolio in the last 3 years. But while this can happen, remember, this is a market. Market means there is a lot of fluctuation. It will keep fluctuating, but over a long period of time, good companies will deliver superior returns compared to bad companies. That is the conclusion of